Hello and welcome to the FCC Farmland Values Report for 2022. Welcome to those who are watching this event live on March 15th, and for those who are watching a recording of this event, thank you for joining us. I am coming to you today from Montreal, Quebec, and I do want to acknowledge that Montreal is the traditional and unceded territory of the Mohawk and Algonquin peoples. It has long served as a site of meeting and exchange amongst nations. And wherever we find ourselves today in Canada, we are on traditional Indigenous territories with rich traditions, stories, and histories that should be understood and honored. And it is our commitment in this spirit of reconciliation and collaboration to honor these people as vital contributors to our society and respect the diversity and strength of all the Indigenous people from across this country. In the next hour or so, we will review the highlights of the Canadian farmland market in 2022. We will discuss the drivers of farmland values and identify the economic factors that we will be monitoring in 2023. 2022 was an eventful year. Inflation showed up across the entire food supply chain in multiple different ways. And multiple factors were connected to the major inflationary pressures that we experienced. We can think of the increase in interest rates, high input costs, shifting consumption habits, and the war in Ukraine and disruptions in the global supply chains that also contributed to creating volatility in the agricultural markets. But one market that seemed to have shown a little bit of stability is the market for farmland. On average, Canadian farmland values increased by 12.8% in 2022. And to understand the drivers behind this increase in land values, I have with me today JP Gervais, Chief Economist at FCC, that will share his insights. So JP, why don't we start by looking at a bit of the history around the Farmland Value Reports. And perhaps I'd like for you to describe the data that is used to build these reports and the methodology that you use to build it.
Well, thanks, Darlene. I do think, and thanks to all of you for watching, I do think it's important to spend a little bit of time talking about the data and how we put the report together. We have a long history of doing so. We've been putting this report out since 1985. And of course, the methodology has evolved over the years, but there's been a constant throughout. And this is how we proceed to calculate those increases, average increases in farmland values that we report year after year. And that brings consistency as well in how we do it and over the years. And so what we do is actually we lean on a system of benchmark properties across the country. So in the course of our operations, we collect data, and some of that data actually is used to appraise the different farmland benchmarks that we have across the country. Those benchmarks are selected to represent a wide variety of different lands, soils, and across all the different regions, really coast to coast. And so we appraise these benchmarks, and that allows us to see how the value of these benchmarks has evolved on average and report the increases that you'll hear about today and that you'll find in the report. Now, the one thing is, well, we want to make sure that this sample of farmland benchmarks that we have is representative of the entire market. So to do this, what we do is we look at our entire data set. So in the course of our normal business operations, we collect data, and we look at the entire data set, look at what the average increase is within the data set, and compare that to the benchmark properties that we have. And when we find a little bit of differences between the two approaches, we made some statistical adjustments to make sure that what we have in terms of data reflect the entire market and the entire farmland market across the country.
So it seems like the quality of the data is really important when you put this report together. And thanks for sharing and giving that time to describe the methodology that you use. So I'd like for us to move into the results right now. So can you describe to us, JP, at a very high level, the overall increase that you've seen throughout the country this past year?
And I did forget to mention, big shout out to our entire team of appraisers that put together the report. Without their outstanding work, this would not be possible. So we'll bring up a map up on the screen that shows not only the national average increase for 2022 that you stated, 12.8% in 2022 on average, but also the average increase you'll find in each of the provinces. Now, we don't have enough data to express with a degree of confidence what the average increase has been in Newfoundland and Labrador, as well as in the Yukon and Northwest territories. But for all the other provinces, as you see up on the screen, I mean, we have average increases that are above 10% in all but one province. And even in that province, BC, when you realize that this is the province that has some of the highest priced land in the country, even a slightly smaller percent increase in BC results in a very significant increase when you measure everything in dollar per acre. So overall, very strong farmland market in 2022, really across the board when it comes to farmland in Canada.
So how do these results, JP, compare to the trends that we've been seeing in the past years around the market values?
Yeah, it's important, I think, to understand how does that compare to previous years. The one thing that we're going to do today as well is to not spend too much time providing you the numbers or the detailed numbers. You can go to our website at fcc.ca/farmland values, or just on the fcc.ca webpage, you'll be able to get a link to our farmland value report, and you'll find tons of information, tons of data points when it comes to different regions within each of the province, different price points as well. It's not just about reporting the average percentages or the average percent increase in each of the regions, but it's also about providing a median price, low end point for prices, as well as a high price. And so you'll have all that information, as well as we've provided quite a bit of improvements over the years, and we now report values for pasture lands as well as irrigated lands. So anyway, tons of information up available on the website. But if you look again on how 2022, just to go back to your question, Darlene, just when you look at how 2022 compares to previous years, we'll put up on the screen here a little bit of a history for the last 10 years of how the average increase in farmland behave. And really what you're seeing right at the bottom of the screen, which is the 2022 average increase, you see that for 2 consecutive years, we've had an acceleration in the pace of increase, right? So we have the average rate of increase that goes up from 2021, and 2021 was also an increase over the pace, over the average increase in 2020. So we haven't had an increase as large as we have in 2022. The last time we had that was in 2014, actually. So a little bit of a surprise, I must say, I must concede, because I remember about 12 months ago when we were doing this, Darlene, I basically said, well, I do expect that the 2022 increase in farmland values to be lower than what we had in 2021. And really, I think now we are looking at an average increase a little bit higher. And so we need to spend a little bit of time understanding what's driving the numbers that we have today.
Well, then let's do that, and let's dive into the drivers of farmland values. So like you said, not so long ago, you and I had the pleasure of recording the FCC 2023 Economic Outlook, and we spent quite a bit of time talking about interest rates. And clearly, I recall how we highlighted that those rapid increase in interest rates that we did see in the past year in 2022, that we should be really monitoring that very closely. And in some ways, I would have expected that with higher interest rates, that we wouldn't have seen such an increase in our land values and maybe a little bit of drop in the demand, and less than what we're actually reporting on today. So how would you explain, and what did your team, how did you dig into interest rates to understand these values?
Yeah, let's talk about interest rates a little bit. Absolutely. So when you think of interest rates first and foremost, right? So if higher interest rates raise the cost of financing when you look at purchasing land. And so to your point, right, we would expect perhaps a little bit of a weaker demand for farmland going forward. Doesn't seem to have happened really, because we have 12.8% increase on average, and it's really just across the entire country really. So if you look at interest rates, let's just document a little bit what has happened with interest rates. So if we're going to put up on the screen the pattern in average borrowing costs for businesses, right? So that looks back all the way back to 2017. And the one thing you know on the far right of the screen really is that interest rates went up, and went up fast in 2022. The Bank of Canada lifted its policy rate by 4%. So that's quite significant increase to what it was at the beginning of 2022. Now, the one thing you're not necessarily seeing up on the screen is the fact that for the last 6 months of the year, the pace of increase in interest rates was a lot higher than the pace of increase for the first 6 months of the year, right? And I do think that's one thing to think about. I mean, we've said this in the past, right? That higher interest rates take time to materialize in the overall economy. It takes time for those higher interest rates to actually have an impact in the economy. I do think that we need to recognize that this is a little bit of the same when it comes to the farmland market. We had businesses that were able to lock in rates at a very affordable level really in 2020 and 2021. And so it takes time for those higher interest rates to finally materialize. And if I think of one of my main takeaways in this year's report, I got two basically, and one of which is on interest rates. And I don't think we've seen all of the impact of higher interest rates. So I do think that's one of the key messages that to think about of this year's report is to think that we're probably likely to see the impact of higher interest rates later as well in 2023.
So the interest rates increased a little bit more significantly, or started to increase in the second semester of 2022. So do we see that increase in the last part of the year really reflected in the numbers that we're reporting on?
A little bit. And so this is a really great question. So we're going to put up on the screen a set of numbers, or two sets of numbers, right? The first column of numbers is really what we're reporting today, right, for 2022, looking at the last 12 months. So that's the average increase of the last 12 months in each of the provinces. The last column on the far right is actually the 12-month increase 6 months prior to that, right? So we're still looking at 12 month to 12 months, so we're comparing apples to apples, but we're looking at mid-2021 to mid-2022. I'm trying here to isolate the impact of the last 6 months. As to your point, right, interest rates, the Bank of Canada rate went up 1.25% in the first 6 months of 22. It went up 3.75% in the last 6 months of 2022, right? So a more rapid pace of increase in the last 6 months. And what we're seeing up on the screen is that the numbers for the last 12 months, everywhere but two provinces, the exceptions being Alberta and New Brunswick, everywhere but in these two provinces, we have a pace of increase in the last 12 months that is slightly lower than the previous 12 months, going back 6 months, mid-21 to mid-2022. Point being that we do have in the last 6 months of 2022 a little bit of a decline, not in farmland values, that's for sure, it's still going up, but a little bit of a decline in the pace of increase. And I think it's important to note that we're starting to see it. It's not that significant right now, but I do think that we're likely to see more of that in 2023.
So if we talk about the demand for farmland, what is the role of farm revenues when explaining the strength for the demand of farmland?
Yeah, so we just talked about one of the factors with regards to farmland, right? Interest rates, when they go up, raises financing costs, makes it a little bit more challenging for businesses to buy land. Another driver of farmland values over the years that I mentioned a number of times is farm revenues. And so if you think of farm revenues, you think of yields, especially if you focus on crops, you think of yields, you think of commodity prices. And the conclusion really, if you're looking at 2022, is that commodity prices were really high. So we're going to put on the screen the price patterns of four main crops in Canada. We got corn, soybeans, wheat, and canola. And really what you're looking at, if you look at the top line, which has a light blue color, you see that in 2022, the prices in 2022 were higher than in 2021 and higher as well than the 5-year averages. So really we had strong prices in 2022, higher than in previous years. And that's part of the result why we have gross revenues at the farm level that went up 18.3% actually. So if you compare gross revenues for grains, oilseeds, and pulses in 2022 compared to 2021, there's been an increase of 18% roughly in gross revenues. And part of it is the result of high commodity prices. Another thing as well is to notice is that we had a good rebound in production in 2022 in the prairies. The 21 crop was not that great. And so we had a good rebound, and that shows up in the revenues for 2022. Of course, the war in Ukraine, if you look at the wheat market, big impact for sure. But it's not just the war in Ukraine. Actually, prior to the war, we were starting in a situation where supply was really tight compared to demand, right? So, even going into the war, we were in a tight supply relative to demand situation with low stocks-to-use ratio from an historical standpoint. So we were, projecting prices to be high. It's just that, the war in Ukraine inserted quite a bit of volatility in the market, but it's also the very robust demand for vegetable oil that really had an impact as well on oil seeds and so forth. So overall, I do think that prices will, and we're starting to see that anyway, right? The dark line up on the screen really says that, prices might be a little bit lower than last year, but I do think that I'm quite confident that prices will remain above 2022, not above, but certainly above the historical averages. So good prices in 2023, and expect some receipts to maintain the level that we had in 2022, and perhaps even go up a little bit, especially in the prairies, right? Because if you think of revenues in 2022, that was influenced by the 21 crop, which was not great. So if we had a good crop in 22, which we had, and a good crop in 2023, fingers crossed, then perhaps we can get some good revenues as well, overall, and that should actually sustain the demand for farmland going forward.
So you're speaking to this, and you're focusing in on cash receipts. I'm noticing, and I'm sure some of our viewers are also wondering about this. You're talking about the gross revenues and the impact on farmland. So how do the higher input prices and the cost of production at the farm level have an impact on farmland values?
Well, thanks for asking. I know you were going there, and I think it's important to mention it, right? Because like when I look at farmland values from a 40,000 feet view, right, and I look at the entire market, really coast to coast, historically, farmland values have been quite correlated with gross revenues, actually more so than with net revenues. But when you look at it from the perspective of a farm operation looking to buy, of course, farm input prices and how elevated they've been in 2021 and 2022. In fact, from 2020 to 2022, we're estimating that input costs or production costs for crops overall, on average, went up 50%, right? 50. So it's a big deal, right? So input prices went up. Input costs went up, and from the perspective of a potential buyer of land, I mean, of course that matters, right? Because you're thinking about the ability to service debt, and the ability to service debt's based on net cash income, and so net cash income is a function of your gross revenues and your expenses. So you need to account for this. You need to account for this in your strategic plan. So when you're considering buying land, it needs to fit your strategic plan. How is that going to allow you to optimize your equipment, economies of scale you're going to get, all those type of things, as well as you have to account for farm expenses when you do your sensitivity analysis, right? When you're looking at, all right, if interest rates go up, what is the impact on debt servicing costs or debt servicing ability and so forth in my operations? What if farm input prices go up? Now we've seen some inputs come down a little bit, and so that's a good sign from a profitability standpoint. Margins have been positive in 2022. Forecasting that margins are going to be positive in 2023. But of course, right, when you look at it from an individual operation, you have to, for sure, account for farm input costs, definitely.
So we've spoken of interest rates, farm income, which are fundamental factors that drive farmland values. And what are some of the other factors that might matter when explaining what we're seeing in the report and the increase in those values?
Yeah, I think we absolutely need to focus this year on the supply of farmland. And that's my second takeaway. I mentioned, my first big takeaway in this is the fact that we've not seen all the impacts of higher interest rates on the demand for farmland and on farmland values going forward. My second takeaway, given that we expected, or I expected at least, that farmland values perhaps would not go up at a faster pace than the year before, ended up actually at 12.8%, a little bit of an acceleration in the pace of increase. So I do think that we need to look at supply. And we did mention supply of farmland in the past, but I do think that, looking at this year, the overall economic environment and how it generated the results that we have in front of us, I do think that supply plays a little bit of a bigger role, I would say, that we've normally acknowledged, let's just say, in the past, right? And so when I talk of the supply of farmland, I got two things in mind. Well, first of all, if you look at the census data in Canada, looking back at the last 10 years, we've lost a little bit of areas when you look at farmed areas in each of the provinces, right? In some of the provinces in Atlantic Canada, we've lost quite a significant large amount of farmland, land that is farmed. Now, it doesn't mean that this land's taken out of agriculture, but it just means that it just isn't farmed. And so we've taken a number of acres down in Atlantic Canada from 2011 to 2021. In Quebec, Ontario lost about 5% of the farmed area. In the prairie provinces, a little bit lower. But nonetheless, we've lost a little bit. So that explains as well the tight supply of land that is available. And the second thing is that when you look at who owns land, there's just not a whole lot available in the marketplace. We're never going to be able, not anyway in our data set, to be able to tell the story about supply. But what we know is that when there's land available, and because supply is really tight, when there's land available, it doesn't take many buyers to create this competition for land, which results in some of the prices that we're seeing today, right? So I think the availability of land for sale is definitely one of the drivers behind the results that we're reporting for 2022.
Mm-hmm. And you mentioned the word buyers. So who are the buyers of farmlands in Canada?
Simple question, not so easy to answer, because there's really a diversity of buyers, right? And when you look at it, if you look at farm operations, livestock, crops, I mean, it's a diversity of different sectors that are buying land. There's also the fact that we have what I call non-traditional buyers of land, businesses, corporations, and so forth that are buying land without the intent of farming it, right? So buying land to lease it, and we're never going to be able to know with a precision, like what's the share of those buyers in the market. Not certainly not from our data sets, but when we look at some of the provinces and we look at the data where we had the information, we think that there's between 9 to 15% for the data that we report and have in our report, between 9% and 15% of those transactions that are purchases made by non-traditional buyers. And so that's significant. The vast majority of transactions are still occurring between a farm operation to another farm operation, but for the most part, there is a share of land that's being sold and bought by non-traditional buyers, businesses or individuals that are buying land without the intent of farming it. And the one thing as well is that the impact, the presence of these buyers in the market is very local. So it might be that in an area it's quite significant, and even if the buyer, this non-traditional buyer, doesn't end up buying the land, the mere presence of this buyer actually changes the dynamics between buyers and sellers, and so that has an impact that we're not able to estimate, right? So definitely an impact. I mean, something to monitor going forward, and hopefully we can get a little bit more data as we over the years to understand what's going on in the trend in the marketplace. But for the most part, vast majority of transactions are still occurring between a farm operation and another farm operation.
Okay, so perhaps one last question for you, JP. What should we expect now for 2023?
Yeah, well, I'm going to take my shiniest crystal ball here and acknowledging that last year I did say that we were going to see a rate of increase lower than the previous year, and turns out that, full disclosure, turns out that it wasn't the case, right? But I mean, to understand, to think about what will happen in 2023, I do think that we have to understand where we're at, right? So one of the ratios that we like to use is the price of land relative to gross revenues, right? So we're going to put two of those ratios up on the screen, one for Ontario, one for Saskatchewan. The one thing you should not do is to compare the ratios across the different provinces. It's hard not to do it because they're one next to the other, but the purpose of this is not to compare two provinces. The purpose is to look at, within a province, what's the ratio like and what's the pattern in the ratio, right? So this ratio looks at price of land relative to gross revenue. So we're making some assumptions with regards to average price of land in the province, average revenues you can gross off the land, average yields, average prices for the year, those type of things, right? And the first thing you notice is that in 2022, despite the large increases that we've had in land prices, we still have this ratio slightly coming down in both provinces. And this is basically true across the country, right? So take wherever you're located, that storyline is pretty much the same. It's just a ratio that will be different, right? But this ratio is moving up. And now, for the last couple of years, it sort of peaked in 2020. And now for the last couple of years, because of the strength in gross revenues at the farm level, especially for grains and oilseeds, we've had this ratio come down slightly. So that's one thing. Yet the ratio, it's still above the long-term average, right? So land is still quite expensive. It's just that it's not at the highest value. One of the things that this does not account for, and we're going to switch to a different slide in just a second, but one of the things that this does not account for is interest rates, right? And we did say, and we spent quite a bit of time today talking about interest rates. So I want to make sure that we are also accounting for interest rates, thinking of affordability. So up on the screen, what we'll do is we'll use much the same ratio, but we'll think of the issue as land payments relative to gross revenues, right? So what does it cost on an annual basis to buy land relative to what you can gross off that land, right? And again, tons of assumptions, right? The idea here is to understand the trends, not necessarily the numbers, but because we're making an assumption about buying land at the average price point, financing 75% of that land, amortizing the loan over 25 years at the average interest rate in that year. So let's just say if you're looking at the ratio for 2022, we're thinking of the average interest rate for 2022. Making some assumptions about revenues. And one of the things that you see is this, now once you account for interest rate, affordability of land actually went in the wrong direction, right? Land is more expensive when accounting for interest rates because this ratio actually went up. Bigger share of my gross revenues needs to be allocated to land. And in fact, one of the things that I like about this ratio is that it illustrates some of the challenges that young producers will face, for example. Because quite clearly, or I don't know if that's as clear as I would like it to be, but nonetheless, I mean, if you're going to buy land, you'll usually need to buy or to bring in some other revenues from your operation to be able to make payments. And just remember as well, right, this particular ratio that you saw on the screen, that was just relative to gross revenues. So that ratio has been moving up. And one of the things, and that illustrates some of the challenges of buying land for operations that don't have the land base, for example, to bring in revenues from other parcels of land or wherever else in your operation you have other revenues. So that's one thing to consider. Second thing is, think of 2022, this ratio going up. This is for at average interest rates. But we did spend quite a bit of time talking about how interest rates were rising a lot faster in the second half of 2022. So if I were to compute the same ratio at the interest rates that we had at the end of 2022, I would have a much higher ratio, meaning less affordable land. And, hence the point that I don't think we've seen yet the full impact of higher rates on the market for farmland. And I think we're going to learn a lot more about it in 2023. So
something to watch for sure. So thank you, JP, really for digging in. This has been really good. And I think a lot of great information that you shared on the farmland reports. So since the release of the farmland reports earlier this week, we've received a few questions on our social media channels. And I'd like to maybe just throw a few more questions at you that we did receive.
Let's do that.
So let's start with the grid question. What are your expectations for interest rates in 2023?
Yeah, so super relevant question, right? So we're taping this Wednesday, March 15. So 4 business days ago, last Friday, major event changed the entire outlook for interest rates. So it just speaks to how volatile the marketplace is right now, right? So let's say 10 days ago, I would have said, hey, interest rates are looking to stay where they're at. If you look at what financial markets are projecting, financial markets are saying that we're going to get a rate cut maybe towards the end of 2023, December of 2023, maybe just one small rate cut. Inflation will cut down to 3% by summer, but it's going to be really hard and a painful process to bring inflation back to 2%. So 3% will get there. 2% will take time. So hence the reason why we think interest rates will remain elevated. Now, fast forward to last Friday when we had the 16th largest bank in the US being insolvent, basically. There was a run on money in the bank. And so over the weekend, what the federal authorities in the US did was backstop some of the losses for the depositors of that institution. I think the crisis was averted in that case. Since then, there's another bank that declared insolvency and so forth. But right now, I do think that damage is controlled, and of course, what has happened then with this bank on Friday reminds some people, certainly it reminds me of what happened in 2008 and 2009. And what financial markets did in response to what has happened, transpired on Friday, Monday, Tuesday, and now we're Wednesday, is we've seen the probability of a rate cut by the Federal Reserve in the US and the central bank in Canada be a lot more aggressive, right? So a lot higher, sorry. And so instead of saying, hey, the rate cut will happen towards the end of the year, now financial markets are saying it's going to happen as soon as summer, June. And I find that a little bit aggressive, frankly. It all depends on, first of all, the banking system in Canada is totally different, safe and so forth, right? But obviously, if we have more bank failures in the US, that's going to trigger a wave of impact. And of course, the Canadian economy being tied to the US economy, then we might feel it as well, might trigger a little bit more of an economic pain for us and so forth, right? I think the markets are a little bit overreacting, but again, as I were taping this, just before starting to tape this, we've heard that there's a bank in the EU now, Credit Suisse, that's facing a lot of challenges as well. So this is a situation to monitor. Indeed, if we have more financial institutions in the world, some significant ones that are running into issues, might see interest rates drop. And in fact, financial markets have reacted, as I said. So there might be the opportunity right now, if you look at a 5-year rate, that 5-year bond rate, for example, has dropped, some more than 50 basis points really since last Friday. So there might be opportunities short term. I do think the markets now are quite reactive to all the news. I think once we get through this and get the confirmation or some sort of confirmation that we're going to be able to avoid those staggered impact and more impacts and so forth, that once we have the certainty that things are a little bit under control, I think we might go back to some of the same pattern of interest rate expectations that we've had, but now financial markets are a lot more aggressive. So this is definitely something to keep an eye on. I do expect that interest rates will remain elevated, but there is short-term weakness for sure because of the events that are unfolding as we speak.
It simply confirms, JP, that it's very hard to predict, right?
Absolutely.
We never know what's going to happen in the short period.
This is why I like my job.
Okay, so what do you think we would need to change in the marketplace to see an increase in the supply of available land that could perhaps potentially put some downward pressure on our land values?
Yeah, you just talked about one of the takeaways I had with regards to interest rates. The second takeaway being on supply, so I think it's very topical to talk about it, right? Because if indeed we find a situation in which there'd be more supply or more land available for sale, that might trigger a different type of price patterns than what we've seen in the last couple of years, right? The two things here. I think as long as the outlook remains positive for agriculture, I don't know that we'll see more land being available. We have, some farm families that are owning land, not farming it perhaps, but owning land and have sentimental value attached to it. And as long as the outlook for ag is positive, I don't think anything will change. I think we'll see very little land being available for sale. Now, of course, if we'd have consecutive years of bumper crops with low demand and lower prices, well, maybe that changes the outlook. But long term, with all the food security challenges in the world right now and the position that Canada has on the global stage, I do think that fairly positive myself. And I do think for the most part, the outlook's very positive. So unless we see, and I don't think that another thing is I don't think that the environment, the economic environment is going to change any of that, right? You might think, well, if interest rates go up, maybe there are other type of assets that farmland owners would like to look at. Yes, but if you look at the farmland returns over the last 10 years, it's been positive. And I would argue it's been less volatile than from a return standpoint than all the other assets you can think of, right? So from that standpoint, as long as that doesn't change, I think the outlook for land is still very positive. I think the farmland market itself is sitting on some good foundations, and I just don't see the supply of land changing drastically over the next so many years.
So a continued perception of the future of how you see the farmland values. Okay. So what are the credible scenarios that could push commodity prices down? So I know that commodity prices have dropped a little bit, and what would push them down below that 5-year average?
Yeah, so good question, because when you think of demand, revenues, commodity prices play a major role. I actually did mention it briefly just from the previous question. I did say, if we had consecutive years of bumper crops or weaker demand, I think short term, if you think of this marketing year and the next marketing year, 23-24, I think the biggest risk is perhaps, for commodity prices to come down, is perhaps a slowdown in demand. We don't think of the demand for commodities in Canada the same way that global markets think of it, right? So if you have an economic slowdown in China, right now, I would say the consensus is that everybody's excited about the economic prospects in China, right? Reopening the economy following COVID-0 and all that, but they have some issues as well. Now, what is unfolding in the financial markets, right, in the US, now it looks as to be somewhat of an issue in the EU, well, could change a little bit of the outlook for the global economy. And if we have a bigger economic slowdown worldwide than what is currently expected, I do think we're going to be able to navigate the next few quarters without a major recession. Maybe we do have growth that is around zero, slightly negative. But if we were to find ourselves in a situation with a more significant recession, a more significant economic slowdown in some of the major importers of commodities, China being one of them, for example, well, that could actually have an impact on commodity prices, right? And so if you think of that, couple this with maybe, some good weather, favorable weather in some, the US, Australia, Canada, and so forth, like large producing countries, perhaps that combines to generate lower commodity prices. But there's a bit of runway when it comes to supply and demand for commodities, right? We're still in an environment that, from an historical standpoint, we got tight supply relative to demand. So if demand slows down, that's a bit of a different story. But I think I'm fairly confident that we can sustain some of those prices above the 5-year averages. Maybe not as high as last year, but nonetheless, I think we can sustain those prices above the 5-year averages.
That sounds like some good news for sure. Yeah. So I think that we'll wrap it up here, JP. Thank you again for sharing those great insights for the 2022 Farmland Value Report. A recording of this event will be available soon to all of those of you that have registered. And for a more detailed look at the FCC Farmland Value Report, as JP mentioned, you can visit the FCC website at fcc.ca, Farmland Values in one word. For FCC customers, you have access, as you can see on your screen, to additional detailed information in your FCC online services account. So with that, again, thank you everyone for joining us, and on behalf of all of the FCC staff, have a wonderful day.